Emerging Market Carry Trade Weakens US Dollar by www.theforexnittygritty.com. Currency speculators are starting to bet against the US dollar in the coming months. An emerging market carry trade weakens the US dollar, but other factors are at fault. First of all, for many, the US dollar is no longer a safe haven currency. Although the political game playing that brought the USA to the brink of default on its debts is temporarily quiet, many are concerned that this is just the lull before the next storm. To the extent that political gamesmanship drives the US dollar, fundamental analysis of Forex pairs is difficult to impossible when half of the trade is the US dollar. As money moves to other currencies, it drives the value of the US dollar down. And many emerging markets are raising interest rates in order to attract capital. Traders move capital out of low interest rate markets into high interest rate ones. This amounts to a carry trade, and an emerging market carry trade weakens the US dollar. U.S. interest rates will stay down until the economy starts to mend more thoroughly and the Fed cuts back on its quantitative easing program, which in turn holds interest rates down. The long term. Every trader has one eye on the U.S. Fed to see when they reduce the $85 billion a month stimulus program, as doing so will drive up U.S. Treasury interest rates and the value of the U.S. dollar. However, the recurring issue of possible sovereign debt default is a serious one for the USA. It could end up like the story of the boy who cries wolf too many times. Eventually, people will start ignoring the USA and banking their reserves in other currencies. When no one shows up to purchase U.S. debt, the rates will go up unless the country learns to live within its means. The long-term issue is still the huge U.S. debt burden. Although currency traders today are focusing on higher interest rates in offshore economies, the longer-term focus may be away from the U.S. dollar. While an emerging market carry trade weakens the U.S. dollar today, not dealing with the debt burden and short-sighted politics is likely to damage the U.S. dollar more severely in the long term. If that is the case, those U.S. dollar assets that are converted to reals, kones, various pesos, rubles, yuan, rand, and rupees may never come back. Trading today as an emerging market carry trade weakens the US dollar. The countries where this tactic will work will be those whose currencies suffered most in midsummer sell-offs. These include the Indian rupee, the Indonesian rupiah, the South African rand, the Brazilian real, and the Turkish lira. As always, timing is important and factors can change. Keep an eye on China, as their debt structure is still suspect and their exports are falling, as Europe and North America are not coming back online as the patrons of cheap products from China that they once were. And when the Fed acts to ease quantitative easing and increase bond yield drive the dollar higher, the short-term situation will change. As always, do your own homework and do not be afraid to sit out a trade that you do not understand. For more insights and useful information about trading foreign currencies, visit www.theforexnittygritty.com.